What if the safest place on Earth to store your fortune is no longer a snowy alpine vault, but a tiny tropical island you could drive across in under an hour? For nearly a century, when people pictured serious money, they pictured Switzerland. Quiet vaults, discreet bankers, mountains, and a currency everyone trusted. But something has been shifting fast, and most people have not noticed. While the world was watching, Zurich, a small nation in Southeast Asia, was quietly building one of the most powerful wealth machines on the planet. Family offices, sovereign backing, rock-solid regulation, and a flood of billionaires moving their money east. This is not a rumor. This is happening right now, in real time, backed by real numbers. Today, we are breaking down 10 reasons Singapore has become one of the most trusted homes for global wealth, how it stacks up against Switzerland, and why the money is moving. Stick around, because point number 7 might genuinely surprise you. Point 1. The family office explosion nobody saw coming. Let's start with the number that stops people in their tracks. Back in 2020, Singapore had roughly 400 single-family offices. These are private firms set up by ultra-wealthy families to manage their own fortunes, quietly, with total control. By the end of 2024, that number had crossed 2,000. That is a 5 times increase in just 4 years. And by the end of 2025, those family offices were managing a combined $66.8 billion in assets, up 43% in a single year. Think about that growth rate for a second. That is not a market drifting upward. That is a stampede. Wealthy families from China, India, and Indonesia have been relocating their capital into Singapore at a pace regulators have rarely seen anywhere in the world. Why does this matter for safety? Because family offices do not chase hype. They are run by cautious advisors whose entire job is capital preservation. When thousands of the world's most risk-averse money managers pick the same island again and again, year after year, that is not a trend. That is a verdict. Switzerland built its reputation over 100 years. Singapore is building the same kind of trust in under a decade, and the family office numbers are the clearest proof yet that serious, cautious money believes the shift is real. Point 2. A government built like a vault. Singapore did not stumble into this position by accident. The Monetary Authority of Singapore, known as MAS, functions as both the central bank and the financial regulator, all under one extremely disciplined roof. That means no confusion, no overlapping agencies pointing fingers at each other during a crisis. Just one strict, unified authority watching every bank, every fund, and every transaction. MAS has built structures like the Variable Capital Company, which lets investment funds launch in weeks instead of months, all while staying inside a tightly supervised framework. It also runs targeted tax incentive schemes for family offices, but here is the key part people miss. Those incentives come with strings attached. Funds have to meet minimum local spending, hire local staff, and follow strict reporting rules. This is not a loophole for hiding money. It is a filtration system designed to attract serious, transparent capital while pushing away anything shady. Compare that to Switzerland, where banking secrecy laws that once defined the country have been dismantled piece by piece under international pressure. Singapore never promised secrecy in the first place. It promised structure, predictability, and control. And in a world where regulations shift overnight, predictability might be the most valuable currency of all. Investors are not just looking for privacy anymore. They are looking for a system that will not collapse under political or legal pressure, and Singapore has spent 2 decades engineering exactly that kind of resilience. Point 3. $5.4 trillion under one roof. Here's a number that puts everything into perspective. Singapore now manages roughly 5.4 trillion Singapore dollars in total assets, which works out to around 4 trillion US dollars. That figure covers everything from pension funds to hedge funds to private banking portfolios, all flowing through one small, tightly regulated city-state. To put that in context, that is more than the entire gross domestic product of countries like Germany or the United Kingdom, sitting inside financial institutions on one island, roughly the size of a mid-sized American city. This kind of concentration used to be almost exclusively a Swiss specialty. Zurich and Geneva built their entire identity around being the place where the world's money lived. Now Singapore is doing the same thing, but with modern infrastructure, English common law as its legal foundation, and direct access to the fastest growing economies on Earth. The money is not just sitting there either. It is actively growing. Asset growth in Singapore has consistently outpaced many of its rivals in the region year after year. When you combine trillions of dollars in assets with one of the most stable governments on the planet, you get something rare. A financial center that is both massive and remarkably calm, which is exactly the combination ultra-wealthy families have always searched for and rarely found in one place. Point 4. Beating Zurich at its own game. In March of 2026, the Global Financial Centers Index, one of the most respected rankings in the world, released its latest results. Singapore landed in 4th place globally, right behind New York, London, and Hong Kong. Zurich, the crown jewel of Swiss banking, came in 11th. Let that sink in. On this ranking, which measures things like business environment, regulation quality, infrastructure, and reputation, Singapore is not just competing with Zurich anymore. It is outperforming it by a wide margin. Singapore even took the leading position in specific categories like professional services, beating out Zurich, Hong Kong, and Dubai outright. This is not a fluke result from one report. Singapore has held a top 5 global position for years, while several Swiss financial centers have slipped in and out of the top 20. The story being told by these rankings is consistent. Investors, regulators, and finance professionals around the world increasingly see Singapore as operating at the very top tier of global finance, while viewing Switzerland as still strong, but no longer automatically superior. Reputation in banking is built slowly and lost quickly, and right now, the data suggests Singapore's reputation is climbing at exactly the moment Switzerland's traditional dominance is being challenged from multiple directions at once. Point 5. The Credit Suisse wound that never fully healed. We cannot talk about this shift without addressing what happened in Switzerland. In March of 2023, Credit Suisse, one of the most storied banks in the world, a bank that had survived world wars and countless financial crises, collapsed almost overnight and had to be absorbed by its rival UBS in an emergency rescue. This was not a small regional lender. This was one of the 2 pillars of Swiss banking, gone in a matter of days. The shockwaves went far beyond Switzerland's borders. Wealthy clients around the world who had trusted the Swiss banking system as an unshakable fortress suddenly had to ask themselves an uncomfortable question. If this can happen to Credit Suisse, what else is vulnerable? Confidence is the entire foundation of private banking, and once cracked, it does not repair itself easily. Combine that collapse with the earlier erosion of Swiss banking secrecy under international transparency agreements, and you get a country still respected, but no longer seen as untouchable. Meanwhile, Singapore's banking sector has never experienced anything close to a comparable failure. Its major banks, including DBS, OCBC, and UOB, are consistently rated among the strongest and best capitalized in the world. In private banking, memory is long, and the Credit Suisse collapse remains one of the biggest reasons wealthy clients started seriously exploring alternatives beyond Switzerland. Point 6. Taxes that actually make sense. Let's talk money, because at the end of the day, wealth follows incentives. Singapore runs what is called a territorial tax system, meaning income earned outside the country is generally not taxed inside Singapore. There is no capital gains tax. There is no estate duty. For a family trying to preserve wealth across generations, this is enormous. It means fortunes are not slowly eroded by layers of taxation every time money moves or a generation changes hands. Switzerland, by comparison, still offers relatively favorable tax treatment in many cantons, but it varies significantly depending on location, and wealth taxes still exist in several regions. Singapore's system is simpler, more predictable, and applies uniformly across the entire country, which matters enormously to families managing complex, multi-generational fortunes. On top of that, Singapore's fund tax incentive schemes, often referred to by their section numbers under Singapore law, offer exemptions on qualifying investment income for properly structured family offices. These incentives are not automatic. They require real local investment, real local hiring, and real compliance. But for families willing to meet those conditions, the tax efficiency is difficult to match anywhere else in the world, and it is a massive part of why so much capital has flowed toward this small island over the past 5 years. Point 7. The people are voting with their feet. Here's the point that might genuinely surprise you. Numbers and rankings are one thing, but people physically relocating their entire lives is another. Singapore recorded a net gain of roughly 3,500 high net worth individuals in a recent year alone, up from around 3,200 the year before. These are not people opening a bank account remotely. These are families packing up, moving their homes, their children's schools, and their entire lifestyles to Singapore. This migration has been fueled heavily by wealthy individuals leaving Hong Kong amid political uncertainty, alongside a steady stream of new money from mainland China, India, and Indonesia. When people choose to physically live somewhere with their families and their fortunes, that is the deepest possible vote of confidence a wealthy individual can cast. It is far easier to wire money to a foreign bank than it is to uproot your entire household and move across the world. The fact that thousands of ultra-wealthy families are choosing to do exactly that, year after year, tells you something rankings and reports alone cannot. Singapore is not just attracting capital, it is attracting the people behind that capital, and that kind of commitment is incredibly hard to reverse once established. Point 8. Protection for everyday depositors. Safety is not only about billionaires and family offices. It also comes down to how ordinary depositors are protected if something goes wrong. In Singapore, the Singapore Deposit Insurance Corporation, known as SDIC, protects deposits up to 100,000 Singapore dollars per depositor per bank, specifically for Singapore dollar deposits. Switzerland's equivalent system, called Credit protects deposits up to 100,000 Swiss francs per client per bank. On paper, these numbers look fairly similar, but the real story is in what surrounds those numbers. Singapore's banking sector is dominated by 3 exceptionally well-capitalized local banks, all of which are consistently ranked among the safest banks in the entire world by independent global assessments. Switzerland's banking sector, meanwhile, is still adjusting to a landscape with one fewer major pillar following the Credit Suisse situation, leaving UBS as an outsized single point of concentration in a way the system had never really tested before. Deposit insurance matters, but the underlying strength of the banks themselves matters even more. And right now, Singapore's 3 major banks are widely viewed as some of the most conservatively run, well-capitalized institutions on the planet, giving everyday depositors a level of quiet confidence that goes well beyond the insurance figure alone. Point 9. A legal system built on trust. Money does not just need a safe building. It needs a legal system that will protect it fairly, predictably, and without political interference. Singapore's legal framework is based on English common law, the same foundation used in countries like the United Kingdom, the United States, and Australia. For international families and businesses, this is enormously reassuring. It means contracts, trusts, and ownership structures work in familiar, well-understood ways, with a court system respected globally for its efficiency and lack of corruption. Singapore is consistently ranked as one of the least corrupt countries on earth, and its courts are known for resolving commercial disputes quickly and fairly, without the years-long delays common in many other jurisdictions. Switzerland also has a strong, respected legal system, built on civil law traditions that have served it well for centuries. But for the growing number of American, British, Indian, and other common law-trained investors and lawyers now managing global wealth, Singapore's legal familiarity gives it a practical edge. When your lawyers, your trust structures, and your court system all speak the same legal language you already understand, moving your wealth there feels less like stepping into the unknown and more like stepping into a system built to make sense from day one. Point 10. The bridge between East and West. Finally, let's talk geography and positioning, because this might be the most important long-term advantage of all. Switzerland sits at the heart of Europe, historically serving as the meeting point for Western wealth, particularly from Europe, the Middle East, and the Americas. Singapore sits at the absolute center of Asia, with direct access to China, India, Indonesia, and the entire rapidly growing Southeast Asian region. As the 21st century's economic center of gravity continues shifting toward Asia, Singapore is not just a beneficiary of that shift. It is positioned as the primary gateway through which that new Asian wealth flows into the global financial system. Analysts increasingly describe the world splitting into 2 major wealth hubs, one centered around Singapore and Hong Kong serving Asia, and another centered around Switzerland, Britain, and the United States serving the West. This is not Singapore replacing Switzerland in some dramatic overnight takeover. It is something arguably more powerful. Singapore rising alongside Switzerland as an equally trusted pillar of the global financial system, perfectly positioned to capture the wealth of the fastest growing region on the planet for decades to come. So where does this leave us? Switzerland is not falling apart, and it still holds enormous strengths built over more than a century of trust. But the era where it stood alone at the very top, unquestioned and unchallenged, appears to be ending. Singapore has spent the last 2 decades quietly building something remarkable: disciplined regulation, trillions in assets, thousands of relocating families, and a legal and tax framework designed to make wealth feel genuinely secure. Whether you are a curious observer or someone actually thinking about where to place your own future, one thing is clear. The center of global finance is shifting, and it is shifting east. If this video opened your eyes to something you had never thought about before, smash that like button right now. It genuinely helps this channel grow. Drop a comment and tell me, would you trust your money to Singapore, to Switzerland, or somewhere else entirely? And if you want more breakdowns like this one, hit subscribe so you never miss where the world's money moves next.